Aloha students and welcome to the lecture on Chapter 9. In Chapter 9 we're going to be talking about a couple of topics, responsibility management in accounting and segment analysis. Okay, so responsibility accounting is basically when managers are evaluated based on how well they manage things under their control. So it's not fair to evaluate managers on things they have no control over. So responsibility accounting keeps track of those things that managers have under their control. So I guess we'll start. You can see here a typical organization chart with the lines of authority. And we're going to be looking at these levels down here, department manager, store manager level. Okay. So here's some facts about responsibility reports. They should be timely, easy to read, prepared regularly. And the main thing with responsibility reports is they are reports comparing budgeted amounts versus what actually happened to those costs. Okay, so segment, that term relates to part of an organization for which a particular manager is responsible. So that can be, as you can see below, individual store, sales territory, a product line. So segments, any part of a corporation where you keep track of costs separately for that part of the organization, that's a segment. There's three types of responsibility centers. Expense centers are a segment of an organization that has costs but not revenues. So an example of an expense center, or sometimes called a cost center, is the accounting department, for example. So the accounting department incurs costs, but the accounting department does not generate any revenues on its own. So that's why it's an expense center. On the other hand, a profit center is a segment that controls both its costs and that generates revenues as well. Investment center is a segment where there is control over their costs and their revenues, but also their investments. So for example, if there's excess funds, an investment center can, on their own, invest those funds to earn a return. Investment centers are also profit centers, to step back, are primarily control over day-to-day operations. So the costs of running an operation and the revenues generated for the operation. But profit centers aren't responsible for things such as the cost of the building, for example, the property taxes on the building. Okay, those are investment center functions. So again, investment centers manage their day-to-day operational costs and revenues, but also their investments and the money that gets put into funding that particular segment. Okay, so you can see the different tools that we use for the different types of responsibility centers. Expense centers, again, because there's only costs, we look at standards. We saw that earlier in earlier chapters, and we look at budgets. So those are ways to control or evaluate expense centers. On the other hand, profit centers do have both revenues and expenses. So the tool that we use to evaluate those are income statements. So contribution income statement, okay, they do generate both revenues and expenses. We look at the profit, the bottom line profit, or the net income of that center. Investment center, on the other hand, we're not only looking at profits, but we're looking at the investment that is made in that segment. So we look at return on investment. Okay, so the rate of return on invested funds or residual income. So we're looking at not just how much income there is, but the rate of return. So how much income relative to the amount invested. Okay, whereas profit centers don't look at the amount invested. They only look at the operational profits and losses. Transfer prices, just be aware of the term transfer price and the general concept of it. Transfer prices is when one segment of a company either provides goods or services to another segment of that same company. So it's an internal sale. Okay, so in order to do proper accounting for the segment, if a segment does something for another segment, there should be some kind of revenue for that segment that does the service. And for the other side, the segment that's accepting services, in order to get a full accounting, they should be charged some kind of a fee for using the services of another segment. Okay, that's called transfer pricing. Again, that's internal prices for charging when one segment of a business does something or sells something to another segment of the business. Okay, there's three different theories or ways for transfer pricing. One is market price. So whatever services are provided by one entity or one segment to another segment, whatever the going rate is, that's what they would be charging. So that's the market price approach. The cost approach is whatever it costs the department who's providing the services to another segment, whatever the cost was, then that's what's charged. There's no profit in the price that's charged to another department. And because it's both within the same company, there is no need to increase the price to reflect a profit, because you can't make money off of yourself. So you might as well just charge whatever the actual cost was. On the other hand, the market price would include some profit in there. Negotiated amount is just like it sounds. Whatever the two segments agree upon should be the proper price. Oftentimes that's a price that's in between the cost and the market price. Okay, but again, this could be anything as long as both parties agree. That's a negotiated amount. Okay, segment analysis. Again, we're going to be looking at accounting for each segment almost as if it's a separate entity. And again, in decentralized organizations, then because the decisions are made at the lower levels, then we have to keep track of how each individual segment is doing. Okay, and we talked about decentralization before, and again, that's where decisions are made at the lower levels. Okay, the concept of fixed, direct, and indirect costs. Okay, direct fixed costs are those fixed costs that are specifically for that one segment and not for the company as a whole. So if the segment went away, the fixed costs that are direct would go away. Indirect, on the other hand, are company-wide fixed costs that a portion of which is charged to each segment. It's allocated based on some kind of allocation formula. But if the segment goes away, indirect fixed costs do not go away. They just have to be spread among the remaining segments of the company. So again, direct fixed costs are costs only for a particular segment, and that would disappear if the segment went away. Indirect fixed costs are costs for the entire company that gets allocated or spread out among all the different segments by some basis, and those costs do not go away if the segment is eliminated. Okay, so here's an example. We have a company that has two divisions, stereos and TVs. So you see here the company-wide contribution margin income statement. That total sales 700,000, variable expenses 300,000, which gives them a contribution margin of 400,000. They had direct fixed expenses of 190,000, indirect fixed expenses of 60,000. So they had income company-wide of $150,000. Looking at the two different segments, so sales of the TV division, 500,000, minus the variable expenses of 200,000 for that division. So the division is contributing $300,000. The direct fixed expenses, and again, these are expenses that are fixed expenses that are only related to the TV division, 170,000. Notice we don't include the indirect fixed expenses in this analysis because this is an amount that the manager of the TV division has no control over. These are company-wide expenses that the divisions don't have any control over. So they're only, again, evaluated on what they have control over, which is the direct fixed expenses and the variable expenses. So the contribution to indirect expenses is where we stop when we're looking at each of these segments, because those are the things that they do have control over. Okay, 60,000 company-wide indirect fixed expenses. The managers of each division have no control over that, so we shouldn't be evaluating them on those expenses. Okay. Okay, and again, we talked about this. So the direct costs are those only for a specific segment. Indirect costs are company-wide that gets allocated or spread out among all the different segments. Okay. Okay, so I guess here's another, whoops. Okay, so remember we had the television division we saw earlier. We could further divide that television division into two separate components, flat panel televisions and high def televisions. And within those segments, there's two other segments within each, US sales and international sales. So we're dividing the segment into further segments. So remember, here was the contribution margin format income statement for the TV division that we saw earlier. We can further split those up into the two further sub-segments, the flat panel and the high definition TVs. And notice the sales, variable expenses. And then the direct fixed expenses are fixed expenses related only to flat panel TVs and 50,000 only for high definition TVs. Okay. So 30,000 of the 170,000 total fixed expense are indirect. So those are division-wide expenses that are allocated to the two product lines. Okay, so, and I think no, we don't. Okay, so we basically, the direct fixed expenses, and let me go back. So this $170,000 direct fixed expenses for the TV division, if you further split it up into sub-segments like we did here, flat panel and high definition TVs, a part of that 170,000 that's direct for the entire division, only part of that is direct for each of the specific products, the 90 and the 150. 30,000 of it is for the entire division, but not only for a specific product. Therefore, that's an indirect relative for each product. Okay. Okay, so one of the ways we analyze or evaluate investment centers, remember, was the return on the investment. And you can calculate return on investment, which is, by the way, a very commonly used ratio in the real world. It evaluates how much money are you making as a percentage on the investment that you initially put into the product or project or segment. So the calculation of return on investment is your margin times turnover. Margin is your net operating income divided by sales. Turnover is your sales divided by average operating assets. Average operating assets are the operating assets at the beginning of a year plus the operating assets at the end of the year. You take that sum and divide by 2. That gives you your average. Okay, so you calculate each of these two ratios, the margin and the turnover separately, and then multiply those two together to get return on investment. They don't tell you this, but for you math types, notice that when you're doing this multiplication, sales is a denominator in the margin, sales is the numerator in the turnover, so you can eliminate the sales. Return on investment then just equals your net operating income divided by your average operating assets. That's a shortcut for calculating return on investment. Okay, so that you eliminate the sales amounts. But if you're looking at the two ratios, two components of return on investment separately, the margin and the turnover, then you need to do the full calculation. Okay. Let's see, so when you're evaluating a company using return on investment or doing that calculation, you're using the net income and the total assets of the whole company. You can also do return on investment for a segment. Again, if it's an investment center, for that we would use, rather than net income, we use the contribution for that segment. And instead of using total assets, we use only the assets of that particular segment. Okay, so that makes kind of sense. Okay, so when you're evaluating a segment manager using return on investment, you should look at only those things that are under the control of the segment manager. And again, theory being, you can't evaluate somebody on something they have no control over. Okay, so here's an example of the calculation of return on investment. So this company had sales of 500,000, income 30,000, and the investment in the assets was 200,000. Okay, and let's assume that's the average for the year. They don't really specify, but it's the average for the year. Okay, so what's the return on investment? Again, looking at the two components, the margin, again, was the income divided by the sales. So that's 30,000 divided by 500,000, or 6%. So the margin is always going to be a percentage. Okay, it basically, in simplistic terms, you can think of margin as what percentage profit are they making on each item they sell. Okay, so they're making 6% on everything they sell. Turnover, as you remember, is your sales divided by your investment in assets. 500,000 divided by 200,000, 2.5 times. Okay, turnover is a measure of how quickly a company sells its product, basically. Yeah. So from the investment that they made, they can have 2.5 times that in sales. So the higher the turnover, the faster they're selling stuff, goods or services. Okay, so the margin is 6%. The turnover is 2.5 times. Multiplying 2.5 times 6, we get 15. And again, it's percent. ROI, return on investment, is always a percentage. Okay, so the margin was always a percentage. Return on investment was a percentage. The turnover is in times. That means how many times per year does the sale get made. So purchase and then sell, purchase and then sell. Okay, so the 15%. Using the shortcut method, Remember, by eliminating the sales in the denominator of the margin and the numerator of the turnover, it would be ROI is the 30,000 divided by 200,000. You'll get the same 15%. Okay? So that's return on investment. Here are some ways that you can improve your return on investment. One way is to increase sales faster than you're increasing your expenses. That's going to increase your income. That helps improve ROI. You can increase your income by reducing your expenses. So cutting costs without reducing sales. So that will increase your ROI. And another way is to reduce your assets and not have that impact your income. Then that will improve return on investment. As I said, return on investment is a very well used ratio in the real world. That's how a lot of evaluations are made on investments. Okay, so here's an example again. This company can reduce assets from 200,000 to 150,000 while keeping their sales at 500,000 and maintaining their income at 30,000. So what's the new return on investment? Okay, so the margin is going to be the same as it was. That didn't change. Again, margin was the excuse me, the income divided by sales. Okay, that's the same as it was before. Nothing changed. However, the turnover, instead of the 500,000 divided by 200,000, now the average assets are reduced to 150. So the turnover now is 500,000 divided by 150,000, or 3 1/3 times. Okay. So doing the math, the return on investment is the margin of 6% times 3 1/3 times equals 20%. So the return on investment increased from 15% to 20% by reducing the assets. Third example again, they increased their sales and increased the income while maintaining the assets at 200,000. Now what's the new ROI? Okay, again, we do the margin is the income. Now it's 42,000 divided by the sales, 600,000. So now it's 7%. The turnover is the sales, 600,000 divided by the average asset or average investment base of 200,000. So 3 times. So looking at the return on investment, 7% is the margin, 3 times is the turnover, 3 times 7% is 21%. So that's the new return on investment. Okay. Skip that. Okay, the concept of residual income. Residual income, the concept of residual income is basically how much more are you making in the company and within your segment. So how much more are you making than what it cost you to make the investment? Okay, so in the investment times your cost of capital. Cost of capital, you learned in Finance 301, is the cost of acquiring new money for a company. Okay, that's the cost of capital. Sometimes you may have heard of it as weighted average cost of capital. Okay, but basically it's how much does it cost us to get the money to make the investment? And whether it's through a loan, through issuing bonds, through issuing stock. Okay, it's how do we get money and how much does it cost us? Okay, so this cost of capital is 20%. So if this company had to go out and get more funds, it would cost them 20%. Okay, so the income for the division is 30,000. So what's the residual income? And again, residual income is what their actual income is now over or minus what it cost them to acquire the assets. So it's the 20% times the 100,000. So you can see there, then the current income is 30,000. The investment is the 100,000 times 20% cost of capital, which is $20,000. So the residual income is $10,000. And that's saying that we're making $10,000 more than what it cost us to acquire the money to make the investment. Okay, so that's good. It's a positive number. So we're making more than what the cost was. Okay, that's residual income. Okay, don't worry about that. Okay, so that's chapter 9. And in the next lecture, I'll talk about chapter 10. So aloha.